What's up everybody, I'm Jaspreet Singh, and do you remember those days where you could sit at home, unemployed, play Fortnite and still get paid more money from the government than you would have gotten when you were working a job? Yeah, those days are gone. In today's strange economy, on one hand you have people that are now struggling to afford their cost of living because they feel like they're not making enough money, and on the other hand, corporations are struggling finding good employees and they're struggling keeping employees across pretty much every sector. It's a really weird combination because on one hand we have unemployment rates that are still pretty low, but people are still struggling to find a good job and find a job that pays them the income that they want. And at the same time, corporations are struggling to find employees to fill their positions too. The good news here is that the strange combination is pushing wages higher. But again, this is a weird combination because now the Fed is saying that this combination of pushing employment prices, wages higher is causing more inflation. So the Fed is calling for a hiring freeze across corporate America to stop wages from rising because they say that these rising wages are contributing to higher inflation. You can really see the different factors at play. And then we have the job market shifting rather quickly because of all the changes that we have in the economy, which is why the job market can be so confusing to understand. If we go back just a couple of years when the pandemic hit and the economy shut down, the industry that surged when everything else was laying off people and closing everything was the tech sector, because the tech sector had the ability to work from home. And so if you could work from home, well, then you could continue working, obviously, but you could also continue shopping online. You could continue spending time online. And so this tech industry boomed and the tech companies were hiring people like crazy when the rest of the world was laying people off. Fast forward to today, and those same companies which were hiring like crazy during the pandemic are now laying people off. Plus, we still have the Great Resignation at play, where people are leaving their jobs because they want to do something that they enjoy, something that gives them more flexibility, something that aligns more with their lifestyles. And then as the cherry on top, you have the economic changes because our economy is going through a weird transition, and that might be flipping the job market completely. The reason and how we got here isn't just because of the pandemic. It also had to do with the monetary policies that we had, because when the pandemic hit, we saw interest rates get cut. And a lot of people were spending time at home on their computers and their phones. So now you could borrow money very cheaply and everybody is spending money online. So naturally, a lot of money went to online digital tech type companies. And now if you had some sort of digital tech type company, it became much easier for you to go out and raise money from an investor, because every investor said, oh my God, these tech companies are about to take over the world. So a lot of money flew and went into these tech momentum growth companies, even if they weren't profitable. Now, the thing that you have to understand here is many of these companies now relied on their valuations, the amount that their company was worth, in order to keep getting more money, because many of these companies were not profitable. And so if you are a billion-dollar company that's losing money every single day, how are you going to continue paying for your employees? How are you going to continue paying for your offices? Well, you need your next round of investors to think that you're worth $2 billion. That way you can raise more money and have more money to pay your employees, have more money to pay your rent, have more money to pay your office structure, and have more money to pay for your software and everything in between. And this was fine when money was cheap, because when interest rates are low, institutions, banks, and corporations can borrow money significantly easier, and you don't need as big of a return to justify borrowing money. Because if you can borrow $100 million at 3% a year, you really only need to see a company grow by 5% a year for that to be a profitable investment. So it was a very low standard to get an investment, and so money was just flowing everywhere. But now the interest rates are going up, the environment is changing, because now investors and banks and institutions are looking at companies saying, well, if you don't have a sustainable profit, if you don't have an actual product that people are willing to pay for, if you don't have ability to become profitable, we don't want to keep investing our money in you. Even though we think, or you say you're worth $2 billion today, we don't want to invest at that valuation. And now if a corporation is trying to raise money at a certain valuation, but people don't want to keep pouring money in there, or they can't keep raising debt, now all of a sudden the value of the company drops. Now you might go from $2 billion down to $1 billion or $500 million, and now it becomes significantly more difficult for you to borrow money or get an investment, because all your previous investors are going to say, wait, I thought you were worth at least $1 billion. How can you raise money at a lower valuation now? And that makes it more difficult for you to keep raising money, to keep paying for employees, which is why you've seen a lot of layoffs across the tech sector, which is why you've seen a lot of hiring freezes across the tech sector, because over the last number of years, Valuations have gone through the roof. And so companies were able to just get so much money to invest in so much growth. And now a lot of companies have realized that they grew a little bit too big, too fast, and now they're needing to scale down. And some companies might be realizing that maybe we have a product that people don't actually want to pay for, and we don't have a path to profitability. So chances are you will probably see some companies shut their doors. So that's the valuation side and why things like the stock market can affect the economy, because if stock prices drop, then companies may be less likely to go out and hire more people because they just can't go out and raise more money. That's happening on one side of the equation. And on the second side of the equation is more of an inflation issue, because now you have companies like Walmart, Target, Amazon. These are your core retail companies. You have the brick and mortar retail and the digital retail, and all three of these companies have come out and said that inflation is significantly hurting their outlook for the future, because now people are spending more and more of their money on their basic necessities, things like food, and they have less money to spend on other things that would make these companies more profits, which is why these companies have been reporting smaller profits, because, well, people just don't have as much money to spend because inflation is so high. But inflation really cuts like a double-edged sword, because on one hand the prices of things go up and people also will need more money. That's why now on top of that, these big retailers are struggling, because not only are they not able to make the profits that they were before, but now their employees need and want more money. So they're not making enough money from selling stuff, but now their expenses are going up because people need and expect more money in order to survive this higher cost of living. So now if you're a corporation and you're not able to make enough money because you can't raise the price of your products enough, and your employees need more money because inflation is so high, that lowers your profits, that lowers your growth ability, and that could potentially lead to slowdowns in the economy and slowdowns in growth for your company, because you're going to say, there's no point for us to keep growing because we can't continue to operate the way we are, and maybe you need to cut costs. Maybe you close stores. Maybe you have to lay people off because it's harder and harder for you to survive with these higher costs. All of these factors coming together are really starting to change the job market kind of quickly, because not too long ago, the job market was completely in the hands of the employee, because every corporation was looking for employees and employees had the upper hand. There was the Great Resignation that was going full force, and people could negotiate stronger incomes and they could do whatever they wanted. Now we're starting to see it's start to shift. We haven't really hit the full shift yet, but we're starting to see this change where corporations are starting to really look at their balance sheets and say, well, we can't keep hiring people at free will. We have to be more picky when we hire, and maybe we have to slow down our hiring. And so if that continues to happen, that could shift the employment market, because now the employers are going to say, well, we just don't want more employees, and that could leave now a bigger surplus of supply of employees, because people will be looking for jobs, and corporations will say, we just don't need more employees because we can't afford them. And then that could change things, because now the employees would say, well, now we need a job. I'm willing to accept a pay cut. I'm willing to do something I don't like. I'm willing to do whatever it takes to go and get a job, and that could completely change the market. So now, if you are looking for a job, especially if you're a millennial or really any generation, there's a few things that I want you to pay attention to. Nobody can predict the future, but it's almost guaranteed that we're going to see more uncertainty in our economy ahead. So if you're looking for a job, it would be beneficial for you to look for a company that is more robust, that has the ability to withstand a lot of uncertainty in the economy. Who knows if we're going to go into a depression or a recession, or if things are just going to get completely better and the economy will continue to boom. It's really hard to predict what's going to happen, especially because we don't know what the Fed is exactly going to do, and that can really impact how everything's going to play out in the economy. So at the very least, when you're looking for a job, make sure the company that you're applying to is robust and can withstand uncertainty in the economy. The second thing that's going to be especially important for you is you have to be educated about money, because anytime you go through these types of uncertainty, you want to make sure that you're taking care of your money, that you're not just cashing out of your 401k in panic, that you're not just blindly losing your money in all these assets because things are going down, because people are panicking. This is where you want to get smart. Look, at the end of the day, recessions, crashes make more millionaires than any other time. And the thing that these people understand is that recessions, downturns are a part of the economic cycle. You can't fight it. I mean, I guess you could try to, but that's not going to work out in your favor. So instead, learn about it, get educated about money, and look for the opportunity. And third, prepare for bad times when times are good. That means put some cash aside to protect you just in case something happens to your company, or if something happens for your job and you don't have an income for a little while. And put some extra cash aside to help you invest if you see a distressed asset come your way. Maybe if you see a stock market downturn, or if you see an opportunity in the stock market, the real estate market, the cryptocurrency market, well, then you can have some cash to go out and buy some assets at a discounted price. But this requires you to have some money, to have some capital in order to do that. And the best time to prepare is when times are okay and when times are good, because now you're preparing for if times go bad, and if nothing goes wrong, well, all you did was put some extra cash aside. So the best case scenario is nothing bad happens and you have some extra cash. The worst case scenario is something bad happens and now you have some cash to take advantage of it. This is where, going back to the first thing that I said, being financially educated is so important. That way you can use the system to your advantage and come out of whatever happens next in the economy as a winner. If you enjoyed this video and you want to see why we might be seeing the largest transfer of wealth ever and how you can capitalize on it, I made a video covering that, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. That way you can take advantage of everything going on around you, because if you don't, you're just going to continue to be a pawn in the system.